Good morning, good afternoon, and good evening to everyone who joined us today from across the world via YouTube, Dreamcast, and Facebook. My name is Deepthi Sirvuri, and I manage international business and customers for HSBC India. I'll be your host for the evening. NRIs are an integral part of our banking. And to bring beyond banking to our NRI customers, we launched this NRI Connect series, where we will bring each month a topic relevant to your evolving banking and wealth needs. This is the first of the series where we would like to discuss one of the primary investment assets that every NRI has on his or her mind. Many of you may be planning your India homecoming after a break of 2 years and more maybe. And real estate, be it a new purchase or a sale of existing one, could be a top priority during your visit to India this time. Keeping this in mind, we bring the session where we are going to discuss the real estate market in India, as well as the relevant taxation that one needs to bear in mind while making an informed decision. I'm proud to introduce our speakers for today's webinar, who are experts in this field and who will help in demystifying real estate avenues and taxability for NRIs in India. Please join me in welcoming our first speaker, Samir Saran. Samir is managing partner in India Sotheby's International Realty. He has over 2 decades of experience in real estate and financial services, both domestically and internationally. Previously, he was the CEO of India City Priority Properties Limited, the real estate arm of KCT Group. He has vast experience across the value chain, be it leasing, acquisition, and development design. He has also spent over a decade in the UK, including as a private banker with Investec Bank, with a focus on real estate. So please welcome Samir. Our second speaker for today is Surabhi Marwah. Surabhi is a partner at EY India, and she also co-leads their Prevent Life Services. Surabhi has over 18 years of experience in various tax and regulatory aspects of employee mobility, compensation structuring, immigration planning, family business enterprise, and most importantly, foreign exchange control regulations. She's part of the EY India tax talent team. She has authored many articles on pertinent issues related to personal tax, employee mobility, immigration, for leading newspapers, magazines, and publications. She has also been a speaker at various forums. She is a chartered accountant and holds a bachelor's degree in commerce from Sri Ram College of Commerce, Delhi University. Samir and Surabhi, a warm welcome to the session. And with your permission, I will straight away jump into questions that our customers may have.
Absolutely. Thank you so much.
So Samir, as it's rightly said, don't put all your eggs in one basket. What's your view on real estate market in India? Is it the right time to invest in real estate?
Being in real estate, Deepthi, I would say that it's always the right time to invest. It just depends. It just depends on you as a person and what you're looking for. So firstly, thank you very much, Deepthi, for having us here. Secondly, good evening, everyone. I would just like to caveat by saying that, Sotheby's International Realty, we are the leading global luxury high-end residential real estate brand, with a presence across 79 countries, with a turnover of about 204 billion and 1,000 offices. So my focus is primarily on high-end luxury real estate. So whatever we're going to be discussing this evening will be within the context of that. I will try and cover a little bit of commercial, but I will not be able to talk much about affordable housing and other categories. What we simply categorize as high-end, we put a number on it, like bankers. So $2 million and above, or thereabouts, internationally. So I'll just start with my brief synopsis of what has happened in Indian real estate, perhaps over the last decade or so. So going back to the golden years, as I call them, between 2010 and 2014, is where you saw a lot of growth in real estate, and people couldn't go wrong by simply investing into residential real estate. Prices just kept going up by magic. And sure enough, there had to be an end to it. Musical chairs had to end. So the government initiated a number of reforms, starting off with demonetization in 2015. And that affected a large segment of the market, which was driven primarily by investors. And I'll come back to this point to discuss, who really are the buyers in today's market. But structural reforms came about. 2017, you saw FDI reforms come into play. RERA was introduced, which was supporting good developments across the board nationally. And you also had GST that was introduced. So the market, after peaking to about 2014, steadily came off. And then we had the pandemic. And the first 6 months to a year, I think everybody was confused about what was going on. But I think the one lesson learned by all was that residential real estate became a safe haven. It became your place to stay. It became your office. It became your school. And so it attracted, it attracted a lot of attention. And that is really where we are today. So a couple of things I just wanted to add over here. There has been growth in demand and pricing since about mid-2020, which has continued throughout the broad spectrum across India nationally. Micro markets specifically, some markets have increased significantly more than others, and we'll touch on this in a little bit later. We've been assisted with a benign interest rate environment. We've been assisted by the government in terms of stamp duty cuts and reduction in circle rates, which has all driven demand. Also, it is important to note, and I think Surabhi will cover this a little later, the buyers today are predominantly end users. Those are the people buying properties and people with the capital gains. Because residential real estate as an asset class is one of the few asset classes in which to offset capital gains. Also, what people are buying has changed dramatically. People are looking for larger homes. People are looking for more flexible homes. People are looking for outdoor spaces. If I had to bucket it between residential and commercial, and I'll just focus on residential here, I would say that there's been a 21% increase across the 7 major metros in luxury residential real estate. The 2 markets that stand out the most are Delhi NCR, which was up 54% over the last 24 months, and Mumbai, which was up 37% in 2001. The Mumbai market recovery has been the most robust. In fact, last month we had the highest number of registrations in the last decade happened in Mumbai last month, actually. Rental growth has also kept pace with this, which has grown by over 18%. So the average rental we're talking about in Mumbai is around 2 to 3 lakh of rupees, and we're talking about apartments here. And there have been a significant number of launches by developers in all branded residences, whether it's Oberoi Realty, whether it's Suntech, whether it happens to be Rustom G or Aditya Birla Group, whoever's covering the gambit. Delhi NCR, on the other hand, was the most affected by demonetization. It saw the sharpest decline, especially places like Noida and Gurgaon, and there has been a steady and strong recovery within that market too. The areas that have kept pace and where we see a lot of attraction is also South Delhi, and in particular colonies where there is a certain bracket or pricing. And again, as with everything in real estate, it's all about location, location, and location. So these assets have both held their worth and have grown significantly in the last 18 months, I would say. Areas like Johor Bahru, Sundarnagar, Golf Links, all in South. The other area I would like to just focus on is your holiday home segment. This has seen tremendous attraction over the COVID and pandemic period. People have been looking for a return to nature. People have been looking for getaways when international travel was restricted. So there has been a growth in the market for holiday homes and second homes. So if I'm in Mumbai, I'm looking within the closest vicinity, whether it's in Alibag, whether it's Lonavala, whether it's Bhavna. If I'm out of Delhi, then I'm looking at jurisdictions such as Rishikesh, Dehradun, Mussoorie, and with the new highway coming up, commutable within 3 hours. And the market that has taken everything by storm has been Goa, which is relatively easier to buy, and I can explain that in more detail if people have questions. So I'll just give you a couple of small anecdotes. We used to do about 30 to 40 crores worth of business annually in Goa. It's a steady market in terms of people looking at it as a second holiday home destination. Last year, we clocked close to 300 crores worth of sales. We have a similar pipeline, this year, and the average ticket size that started at 5 crores, which would be the equivalent of, 500,000 pounds, has gone, closer to, with the depreciation in exchange rates. I think it's a little bit more expensive for the people from the UK. However, that has almost doubled. So today people are looking at budgets at 10 crores, so close to the 800,000 to £1,000,000 and above. Our average transaction size last year was closer to 30 crores, and our most significant sale actually out of Goa was 90 crores. So last year somebody spent £9 million buying a home in Goa. That is again driven by a number of supply-demand dynamics. That's driven by the new airport coming up. It's driven by temperature, weather, restaurants, food, and the whole ecosystem that's been created there. So those are the three areas within residential I would like to cover. I'd just like to add 2 lines about commercial real estate. The private equity investment into India, totaled about 34 billion in the last year, of which 1 billion was in commercial real estate in the first quarter of this year. Between January and June this year, there have been 711 transactions that have taken place. The trends that are running from a commercial perspective is, again, it comes back to pent-up demand. The people who couldn't expand businesses during lockdown and during the COVID pandemic period over the last year have gone into accelerated mode and are looking to expand. Number 2, it's return to business as usual. I'm sitting in my office. Many people are sitting in their respective offices. So it's back to office culture. And again, this is an asset class where we foresee higher capital appreciation, even more so than residential real estate, simply because I have a tenant and it's a grade A building. It will always attract a grade A tenant. They will always pay me rent. It'll be over a duration. I'll be able to raise that rent. And the way I calculate the valuation of my commercial assets is done on that basis. So at that point, I'll hand back to you, Deepthi, and say that I think, again, as I said, it's for everyone to look at, but I think it's a very interesting time to look at Indian real estate.
Very interesting insights, Samir, and I have too many follow-up questions on that, but I'll come to you in a while. Surabhi, most important question that keeps coming to NRI's mind while buying a piece of property in India is to comply with all the rules, and because of their non-familiarity with the Indian laws, taxation becomes complex to the least for them. Right? What are the key things they should keep in mind before buying a property?
Thank you so much, Deepthi, and thank you for having me on this. Before I get to the very unexciting tax piece of it, after hearing all the glamour from Samir, when can I please be your client? He said, I only deal with high-end, luxury property. So this is my pet peeve with him. The day I can be your client, that means that's the day I've arrived. It's not this day right now, though. So please don't try and sell me anything. But coming back to tax, 2 important parts, tax and, exchange control. A non-resident is allowed to buy residential and other real estate in India, no problem at all. The only thing where there is an embargo is if you're trying to buy agricultural land or certain plantations. So if you're trying to buy farmhouses which are very far away, you need to see the categorization, because that is not allowed under our FEMA or exchange control guidelines. And there are several nuances to that. So I'm just giving you a broad idea that if you're looking to buy these things, come back and get someone to advise you and see if that's okay, if that's kosher from a FEMA perspective. The second part of it, which not a lot of people know, and I'd like to spend a little time on this because this is also very effective and very important for planning. As a buyer, if you are a buyer, as a non-resident buyer, when you buy a property, you are required to do a tax withholding, because the government says if I am paying someone money, I have to do a withholding tax. And this was instituted a few years ago, so that the government could know when somebody was selling a property, so that they could report capital gains. And how do they know? The minute I withhold tax from a buyer, it comes under in their foreign asset, or not a foreign asset, but Form 26AS reporting, and therefore the government gets to know. So if I'm buying property from a resident, so I'm a non-resident, but I'm buying property from someone in India, I'm supposed to withhold tax at 1%. If the consideration or the sale price is more than 50 lakh rupees. So keep that in mind, that you have to do the withholding. And if the seller says, no, you don't have to do it, or, let's not do it, that's not correct. You have to do it as per law. The more important thing is, if I'm a non-resident and I'm buying from another non-resident, so if the seller is also non-resident, that's when the complication comes in. Because under our tax rules, if you are buying from a non-resident, you as a buyer have to deduct tax at 20 or 30%, depending upon whether it's a long-term gain, long-term asset, whether he sold it after holding it for 2 years or less than 2 years. Now, this is a huge thing because the seller will say, you are going to withhold 20 or 30% tax from me, which is huge, but that is the law. So first thing, yes, it is the law. Non-resident seller always gets into this. The second issue is that as per the law is worded up, it's a little confusing, if I may say so, because if you read the plain reading, it says that the buyer has to deduct this 20 or 30% based on the sale value. Now, tomorrow, the capital gain amount could be nothing. It could be a loss, or it could be much lower than the sale value. My sale value is $20, but my capital gain could be 2 because you're getting various deductions, indexation of cost, etc., etc. But if you as a buyer have withheld 20% on say 20, which is the sale price, but his gain is 0, that means that there is an extra tax that you've deducted, which that seller has to claim as a refund. And everybody is still scared of refunds. Though trust me, it's not so difficult. I got mine 2 days after filing my tax return. But yes, there could be scrutiny and there could be delays, etc. So as a non-resident seller, it is prudent to calculate the capital gain, go to the government and say, look, my sale price in my example is 20, but my actual gain or the actual gain could be 2 or could be a loss. So please issue me a lower withholding tax certificate, which I will give to the buyer and tell them, therefore, not to deduct that 20 or 30% on the sale consideration, but on the actual capital gains. But if your seller tells you, no, please don't do it on sale consideration and I've calculated this number and do it on that, you may not be on the right side of the law. So you as a non-resident buyer need to know, one, there is a withholding requirement that you have to comply with. And that depends on whether the person selling to you is a resident or a non-resident. And two, if that person is a non-resident, he may come up and tell you, please don't deduct on the sale price, deduct on a lower amount. So then you've got to say, okay, do you have a lower withholding tax certificate? And can I just see how you calculated the gain? Very often people don't know this. So they end up not doing the withholding tax or doing it on a higher or lower number. And that compliance issue becomes the issue of the buyer, not the issue of the seller, because this onus has been given to the buyer. So ladies and gentlemen who are both non-resident buyers and sellers, you've got to take this into account and get the right guidance and get this TRC or lower withholding tax certificate done in time so that your buyer doesn't deduct tax at the higher amount. I'm not going to confuse people further. Back to you, Deepthi, but this is a very important one and I've seen people go wrong and I've seen a lot of HSBC NR customers now come to us and say, hey, help me with this certificate. It's not very easy to get. It takes a couple of follow-ups, but everything is becoming automated. So it's, we're hoping this will become automated as well. Back to you.
That's not so complicated, honestly, Surabhi. Just have to take care that it's not agricultural land when they're buying farmhouses and just ask the chartered accountant on the withholding tax. Two important questions.
I've got to make it a little complicated. Otherwise, then, nobody will ask me to do anything. So
don't worry. My NR customers are like very diligent. They want to know. But thank you for that. Samir, very interestingly, you've mentioned 21% increase in housing prices. So I'm going to put you on a spot here. I'm going to ask the question, which is on top of most of my clients. What's the return on investments our client can expect if they decide to invest now in this market? Okay. And as most of our NR clients may want to let out property on rent, obviously they've not been here, what kind of rental incomes can they expect?
Okay, so both my answers will be relatively short. Within the context, and I'll come back perhaps and give a comparative later, in terms of where residential commercial is vis-a-vis the rest of the asset classes. Just whatever our two thoughts are on this. We foresee, a growth in these returns on residential real estate being around 5% for the year 2022. Now, again, I keep saying this because it's actually true. It's very micro market specific. There was recently a transaction again concluded in Goa where one would not have thought somebody would have paid so much money for that particular location at that particular place. So whoever sold it got a fantastic return. So again, it really depends. I'm speaking now more broadly, and therefore I've taken the number of 5% in terms of residential return. Commercial return, I won't get into. In terms of the trends on renting, if people own assets over here, they've been sitting idle. So there are two parts to this. One part is people have feared giving their apartments to to general public. There's been a pecking order in terms of who they lease out to. So it starts with the embassies, then it moves down to the MNCs, then it comes to listed companies, and finally it goes to independent Indians, which has been a challenge for locals who live in the market, but are good clients and good profile clients. Having said that, what we've seen is a lot of return of diplomats, and we've seen a lot of people from MNCs coming back to India. So during COVID, there was a lot of evacuation. A lot of people left the country. Posts were not filled, and things are going slowly. But we've seen a significant surge in that. So I said the overall rental market was up, 18%. But in certain micro markets within Delhi, Central and South Mumbai, it's grown as much as 60%. Also, something to do with interest rates moving up, because it's moved up, 1.9% over the last 5 months. Where people are more attracted to coming back into the market on a rental basis as well. We've also seen rents going up. So rents have gone up 14 to 15%, across the board again. So, so from a rental perspective, the market is looking good. However, on a gross basis, rental yields across the major metros still remains between 2 to 3%. Which I believe is also compatible if we're looking at a Japan or a US or a UK. So they all fall within a similar kind of bracket, and some variation for micro markets. Where it is particularly interesting is again the holiday home segment. So I was talking gross yield of 2 to 3%. In the holiday home segment, I've seen net yield of about 4 to 5%. So whether that's people renting out their homes in Alibag, or it's people renting out their homes up in the hills, or in Goa. That's the kind of range in return. And I know Surabhi has a getaway home too, so I'm sure she's also making a great return on that. If you look at yields across commercial and grade A commercial real estate, whether you take office space, whether you take warehousing, whether you take retail, it's usually between that 8 to 9% range. So these are quite attractive, in terms of what it is. Depending again on the asset, the location, the quality of the tenant, it will vary slightly. Hospitality is another sector that has seen a lot of excitement, especially in the last 8 months. And those are assets like hotel assets or motel assets, which are trading at 12 to 15 times EBITDA multiples. So again, is it possible to rent out properties? Yes. Will it give you a fantastic return between 2 to 3%? Do we see an increase in that? Yes. Are you getting good quality clients? Yes.
Thank you. That's optimistic. Surabhi, a connected questions. How is tax calculated on rental incomes for NRIs in India?
So rent doesn't have any special tax rates, unfortunately, and I hope, Samir, the government listens to you and they reduce the tax rate on rent. So the yields and the taxes go hand in hand. But what the government has done, it's not just plain vanilla rent and into the tax rate. You get a couple of deductions. One, you get a flat 30% off. So you don't need to give any bills. You don't need to substantiate. So 30% just goes off rent minus 30%. You also get get the deduction for municipal taxes. And a lot of people ask me, is it on, if I've forgotten to pay my taxes in the past and I paid this year? It's on payment basis. So if I paid this year, I get a deduction this year depending on the receipt. So that's two. The third thing that I get off is the interest that I pay on any housing loan taken. Many years ago, there was no limit to this interest. And so whatever rental you got and whatever interest you paid, if there was a negative amount, you could just set it off from your income, any amount. But the government sort of changed that a couple of years ago. So now what happens is you have rent, you have 30% off municipal taxes, interest on housing loan. Now, if after these three deductions, the number that you get can be set off from any other income, any others, for example, if you have salary and etc., but only to the extent of 2 lakh rupees. So earlier this was not capped, whatever it was could be set off, but for the last couple of years, this number has been capped. Now let's assume that my loss after the rent minus these 3 deductions is 4 lakh, 2.5 lakh rupees. I can set off the 2 lakh rupees against my salary income. So my salary income gets reduced to that extent. 50,000 rupees I can carry forward up to 8 years. But when I carry it forward, I can only set it off from house property or rental income. So in the first year, I can set it off against any other income. When I carry it forward, I can set it off against only rental or house property income. Typically what happens is, and I'm not the bearer of good news here on this one, but because it's only 2 lakhs every year, even if you carry forward, because the income or the loss for that year is 2 lakhs or more. So eventually what's happening is that after 8 years, this sort of gets wasted away. But like I said, while the rate is the same, normal tax rates that we have, but you get a lot of deductions. And after these deductions, you end up, the effective tax rate on rent becomes much lower than the actual or the maximum marginal tax rate. So that's how it goes. And no special rates for NRIs on the rent.
Yeah, but it also leaves an option for NRIs. To Samir's earlier point, if the rental income grows at 14-15%,
Absolutely.
They at least have an option to offset it in the following 8 years.
Absolutely.
Thank you for that, Surabhi. Samir, next question to you is, most of our clients, had already bought a property. Most of the NR clients would have a property in India. So assuming somebody bought a property maybe a decade back, like in 2012 or so, and they want to sell and book profits. Do you think it's a good idea to sell and book profits, or because there could be a continued growth and momentum, they should hold?
Okay, this is again a difficult question in that I believe that the real estate market, at least for the next 12 months, is going to be robust and move ahead. And that's, I'm again talking residential, but even more so than residential, commercial real estate. Having said that, it has to be assessed on a case-by-case basis, depending on what the person has bought, where they bought it, at what price they bought it, and where are things today. If I look at it from a bit more of a macro perspective, and I'm just looking at the economy as a whole, I think there is still a significant amount of pent-up demand left over. There are people from the pandemic who have done stake sales. There are people who have become unicorns. And these people have only 1 or 2 avenues in which to either invest, to own homes, or to actually offset their capital gains tax. So that is one major driver that we have seen in residential real estate that has kept it buoyant and kept it positive and kept the momentum going. And I think Surabhi can talk to you about what she sees happening because from a tax perspective, they're dealing with a number of different clients. The kind of ticket sizes, and I won't go into specific names, but it's been reported that there were clients that had 3,000-4,000 crore sales and then went on a shopping spree for assets because it came in a couple of different family members' names, so they could. So that is definitely a dynamic that has changed and is also currently driving the market. Coupled with that, of course, I would still say, whilst there has been an interest rate rise, we're still in single digits. So it's still fairly attractive for people. There is strong economic growth still predicted, 7% plus. Most people are saying between 8 to 9%. We're not suffering from some kind of energy crisis like many UK or European markets as well. We have a stable job economy at the moment. So I think all these factors, from my perspective at least, shows stability, growth, and a good time. But again, when it comes down to assets, one has to be specific, one has to look at it. And I'll just tell you, just to give you an example, plots sell better than apartments. And then there's a difference. If you're in Bombay, there are only apartments. Then, within apartments themselves, a third in terrace will attract more people, and a basement and ground will attract more people than the apartments in the middle. So it really comes down to, what is it? Where is it? What was it purchased at? And we can do that valuation. We can do that assessment. we can see, you know, what the correct timing of the market should be for assets like that.
Yeah, makes sense. Thank you. Related question again, Surabhi. If they choose to sell, how is tax calculated on a sale of property in India?
So it's capital gains, and we have two brackets of capital gains. We call it long term and short term. Anything sold before 2 years becomes short term. So you have regular tax rates, 30% plus plus. Anything sold over tax years is beautiful because it becomes long term. You have one, a lower tax rate of 20%. Two, in the budget that came last year, they capped surcharge at 15%. So, so your effective tax rate became very low. So if you are trying to sell your property, unless you're getting, unless the business reasons or you're getting a great value for it, it's much more prudent to keep it for 2 years because you get a lower tax rate. The surcharge has been capped. And another thing you get is when you deduct the cost of acquisition, like you calculate gain, there is sale consideration, which is the sale price minus what you bought it at. That cost also can be indexed. So you can use the cost inflation indices and bring up, say, what you bought for $10 you can bring it up to say 12 or 14 or 15. And even for inherited property, they've given a base year for you to use as a inflationary index so that you actually only pay tax on the actual capital gains. Another thing that Samir has been alluding to right from the beginning is that people are buying and are when they are looking to buy property, a very big motivation is that there are certain tax breaks if you have a capital gain and you reinvest it into a real estate or other asset. Now, what happens is these are called rollover provisions. If you have a long-term capital gains, and again I said what is the benefit of long versus short. So the first benefit was the rate, then the indexation. You also, if you have long-term capital gains, you can reinvest this money into either another residential property or you can invest it into bonds, etc. So there's something called Section 54. I'm not going to go into many nuances. Again, the reason is that you as sellers, etc., should know that if you want to save tax, you can actually reinvest the money into another property. There are certain restrictions. For example, when can you buy this property? When can you sell this property? And if you don't do it in time, you can open something called a capital gains account scheme in a nationalized bank and park the money and therefore save the tax and reinvest it later. If you, and the beauty of these, these sections are that even if you sell an asset which is not a real estate, for example, a stake sale, or you do an exit in your startup, etc., again, something that Samir alluded to, and you invest it into another house property, you can again get a tax break. That's called Section 54F. So what is important to note here is that one is, like I said, buying, selling. Samir talked about the great rental yields. He talked about holiday homes, about about how the psyche of people has changed vis-a-vis real estate. And, it's back to office, but a lot of people are still doing hybrid. So once a week or so, they do end up working from home. So they want the setup. But the very big consideration also is, if you make gains, if you reinvest it into a property, and depending upon the type of gain, you can actually save all or a portion of the capital gains, which is a very big incentive for individuals. Of course, if the gain is 3,000-4,000 crores, you may look to put some part in real estate. Some you may do different types of tax planning, which is possible under the ambit of the law. But this is a great motivator for people to say, look, I've sold, but I'm an NRI, I have roots in India, and I want to now go to golf links or Sundarnagar, or as Samir said, in Bombay, etc., or Bangalore, wherever, and I'd like to reinvest, and I'm getting a tax break as well. So it's like, as they say, snap. So those are two very important things to note.
So Surabhi, if it's okay, I would want to ask two related questions that have come from our viewers and customers on the capital gain part. So the first question is, when looking to reinvest long-term capital gains into property which is already purchased, should the sale be within 1 year from the date of allotment or date of registration? That's the first one.
Sure.
The other one is, how many properties capital gain can be invested into for one property purchased in a tax year?
Okay, so the first, both the questions are relating to the first section that I spoke about, section 54. And I'm pointing this out because a lot of you would like to go back and refer or come back to us. So don't look at at a wrong section. They all sound the same, but they are very different. If you sell one property and you want to reinvest into another property, so you've sold the property and you want to reinvest into another, the purchase of the new property can be made within 1 year or 2 years after the date of transfer. So 1 year before or 2 years after the date of transfer, or you can construct it within 3 years after the date of transfer. So to the question, what if I had already purchased it? If it is within the 1 year period of the sale, 1 year before, you will still be able to get the section 54 exemption. If you bought this property 5 years back and you're selling it today, the other property today, and you want to take that benefit of 54, you can't. But if you did it within 1 year, then you can. That's the first one. The second one is, if I've sold one, and how many properties can I reinvest? Under section 54, you can typically reinvest into one. And that is also located in India. They clarified in the law. But if your gain or if your consideration and gain is less than 2 crores, then you can even invest it into 2. So therefore, keep this into mind and read the section, look at the amount of sale consideration, and you may be able to then reinvest into 2 if you're doing a section 54. Section 54 applies if you've sold an asset which is not a house property and want to then invest into a house property. There, the section is a little different. You will have to go into the nuances of that section. I hope that clarifies, Deepthi.
Yeah, very clear, Surabhi. Thank you. Samir, coming back to you, you've briefly alluded to the interest rate scenario right now. So with the recent repo rate hike, do you think it deters home buyers in India? And how is the real estate better than investments in, say, mutual funds or stocks?
Yeah, I would, so 2 things. In terms of interest rates rising, it's risen 1.9% over the last 5 months. So it's always, a detriment, or it does dampen sentiment, generally speaking. I think it affects the affordable housing segment more than it would the luxury housing segment. Having said that, we do have clients that have taken significant loans against large size assets. That being said, I think the way developers overcome that is to offer incentives to clients, whether it's flexible payment plans, whether it's additional features, benefits, etc. So from a primary product sale perspective, so developers, they manage that through a number of different incentive schemes that make up for that. So that keeps the buoyancy, that keeps the sentiment from a primary perspective. From a secondary sale perspective, again, as I said, more on the affordable side, less on the luxury side. We've seen continued buying, and as I mentioned to you, September in Mumbai saw the highest recorded registries in the last decade. So I think that's a significant indicator as to what it is. I don't believe that I shouldn't be comparing assets against one another, whether it's stocks, shares, debt instruments vis-a-vis real estate as an asset class. Only because I truly believe that you should have a diversified portfolio. For anybody, should have a diversified portfolio. You do need the one roof over your head. You can decide to, reinvest into commercial real estate as a form of regularized income. But of course, you'll still have your basic financial instruments within the portfolio. You'll keep some amount of money for liquidity. And as an HSBC customer myself, I hope you would be advising me that too. So my point is, one would look at a diversified portfolio firstly. Real estate always sees a flight to safety. It did at the time of pandemic. If we see the world going into a shocking recession, everything eventually catches up and all asset classes move in the same direction, what I've seen from a 3-year cycle. However, real estate is the last to follow in and not always the first to come out. Having said that, I wanted to just share some numbers or data that, over the last 2 years kind of thing that I was able to get from CRE matrix. So firstly, we see residential real estate with a return or profile of about 5% in this for the balance of this year. So some these are the key facts I wanted to share. Out of the last 10 years, at least one real estate asset class has surpassed the Sensex for the last 7 years. So out of the last 10, at least one, whether it's commercial or residential or hospitality, they have done so. 4 out of the last 10 years, real estate assets have topped the asset class return charts. 5 out of the last 10 years, we've witnessed double-digit growth in at least one real estate asset class, whether it be residential or commercial. The 10-year CAGR or growth rate for residential returns or ROI on residential assets has been close to 6%. That's the last 10 years of return. For commercial, it's been closer to 10%. And for the Sensex, it's been closer to 12% as well. 2021, residential return ROI was around about 4.5–5%. Commercial was around about 9%, and the Sensex was about 60%. We've seen somewhat of a reversal in 21-22, where residential is giving you a return of 9%. Commercial has given you a return of about 25% ROI, and the Sensex is at -1%. So that just gives you a perspective in terms of how assets are moving. But I think you're better placed to advise clients on their portfolio and whether they should be moving in or out.
Yeah, absolutely. So diversification is the mantra, and that's what we strongly advise and recommend. But to that point, Surabhi, how does the real estate taxation compare with taxation for equity or debt?
So tax rules for taxation of equity and debt, especially listed and unlisted, is very complex because we have, mutual funds are different, shares are different, listed and unlisted are different. But just to give you a synopsis, I just talked about, taxation of real estate, long-term 20% plus 15% surcharge and cess, short-term, which is less than sold before 2 years, is regular tax rate 30% plus. If you compare it with equity, and I will look at typically shares, because that's where people, who are dabbling in real estate will look at shares, the equity market, versus real estate. Listed shares become long-term if they're held or they're kept for over 12 months and not 24. So that's the one difference. It's not a one kind of 24 months period for every asset class. It's 12 months for listed equity shares. And those are taxed for non-residents at 10% plus the surcharge. Again, the surcharge is capped at 15%. That changed a few months back or a year or so back, where for listed shares, they kept it at 15%. You get an exemption of 1 lakh rupees, just 100,000 rupees on the capital gains. And beyond that, all the capital gains are taxable. Short-term capital gains, which is held for less than 12%, there is a beneficial tax rate of 15% plus. When I say plus for surcharge and cess. So that's how the listed shares compare. Unlisted shares, the tax rate again is 10%, surcharge is 15%. But for non-residents, you don't get indexation benefit for unlisted shares. So your cost of acquisition cannot be bolstered up for this, for the cost of inflation index. And tax on short-term capital gains is your applicable rates. So that's how the complication happens. Dividend income, we know the law changed a couple years ago, and it is taxed in the hands of individuals. For non-residents, it's 20%. Again, the cess is a maximum, the surcharge is a maximum of 15%. But for non-residents, and because we are talking about non-residents, they are treaty residents of, there is a tax treaty that can be invoked, because typically tax treaties are invoked if you are a resident of one country and a non-resident of the other. And typically tax treaties do prescribe a preferential rate for dividend, depending upon the type of tax treaty, or depending upon the country that you're looking at. So this is very, very important. And in fact, countries like Dubai, etc., became complex because our laws on taxation and residency changed, and therefore dividend income tax rates also changed. So if you compare, please compare, do a chart. It's not 12 months and 12 months. It's 24-12. The rates are different. The indexation is different. So it's a very interesting calculation, and you're going to have to feed in completely different formulae for real estate, for listed and unlisted shares, and even for listed and and also for mutual funds, depending on whether they are equity and debt. I don't want to get into the thesis, but these are different asset classes that taxation differs. Back to you.
I think most important is there are nuances pertaining to each of them. And it's important that customers do look at short-term versus long-term between the various asset classes. Thank you for that, Surabhi. Coming back to Samir. Samir, you have mentioned the increased activity that's happening in India, right? And especially the Mumbai and Delhi NCR, the 51% and 37% growths that we're seeing in the top cities. Do you have a view on Indian cities and the type of properties that could be potentially attractive to our clients in the current market?
You're on mute, Samir.
Sorry, I was saying the main metros seem to attract a lot of investor attention. As I said, there are specific micro markets. South Mumbai is a particular micro market. Central Mumbai is a particular micro market. Going out towards the suburbs is a particular micro market. So depending on what people want to do, if it's purely investment, and I'm going to be frank and say if it comes down to pure investment and there is no other secondary motive, then perhaps commercial real estate is something worth looking at. Only because the return profile is better, you get a good tenant in, you get a pre-leased asset that hopefully the rentals will grow over a period of time, and as a result, your capital values will also grow commensurately along with those rental yields. And you also get some kind of a steady income. If people are looking for being able to use the asset partly and also enjoy it, then the holiday home market or the holiday home segment is quite attractive because technically speaking, you can buy a home in Goa, you can put it on rent, you'll get 4 to 5% rental yield. It'll be and today the market dynamics have changed. There are enough people in the market, good quality people who will manage the properties for you. In yesteryears, people always had to look after their own asset. They had to employ somebody in their house. They had to keep someone there to make sure taps were run and things were managed. So today that landscape has changed. There's more professionalism in terms of managing assets and holiday home assets in particular, whether it's up in the hills or whether it's in a Goa or any other jurisdiction. So, and your yields there are significantly better. And as a family, so if you're traditionally from, Maharashtra, or you're traditionally from Mumbai, and you wish to buy an Alibag, then at least you and your family will get some use out of it when you come back to India. And you can plan that accordingly. And lastly, if it's for yourself or if it's for your parents, there were many people during the pandemic that wanted their parents to move out of the apartment that they were in, have better spaces, be and perhaps look at Antara, which is in Dehradun, which is a beautiful center that where people go to retire, and it's a gated community. It has a hospital close by, etc. So again, it really depends what the motivation for the individual is. If it's just purely investment and a return profile, or it's also to get some kind of usage as well as comparing that with a return. For those people, apart from the UK, I would say the way exchange rates have moved, it's been and again we deal with a lot of NRI clients looking to come and buy into India just because of the the exchange rates, and it's extremely attractive for them to buy in at this particular rate to upgrade their existing homes, sell off what they don't need, or reposition it. People may want to come back and they may want to retire in Delhi, or they may want to retire in Dehradun. They don't want to have their existing home there. So one would sit, one would understand, one would see where capital values are, and then one can sit down to properly advise a client in terms of where to position them and how to position them.
Yeah, thank you. Thank you for that, Samir. In fact, one related question from one of our customers, Malasha. Is residential land in Mysore good time to buy?
Is she advising me, or am I?
A question here. Is it a good time?
I wouldn't know specifically. And I'll be frank with you. We don't cover Mysore as a market, and we don't cover land specifically in Mysore as a market. Let me be clear. So I wouldn't be able to tell you. And again, it would depend on the location and the locality. One would have to assess where is it and in comparison to what else. What we've done is, and as a business, what we've done is to give, especially NRI clients who are sitting very, very far away, to give them clarity on, what all has transacted, where all it is transacted, or what kind of pricing, is there. So we work with people. We've got a company called CRE Matrix who we've invested in, who does a lot of data mining, will identify particular transactions that have taken place in a locality. And I think that's what people appreciate, who are sitting very, very far away and don't have a good view on a particular asset or an asset class. Should I be selling? Should I be buying? Somebody's told me this, somebody's told me that. So rather than that, give you things in black and white, ink on paper kind of thing, and have full transparency in terms of where things are at. The answer to the question in short is, I would have to understand where it is, and then I could give you a proper reply.
Thank you. Surabhi, most important question is, what are the FEMA guidelines for NRIs to buy property in India?
So Deepthi, just before I go to this question, I think there was this question that you had asked me on section 54. So just to re-clarify, the way the section works is that this benefit that you can sell one and buy two happens only once in the lifetime. So that's the way the interpretation is. I forgot to tell our user that. And it's, if the capital gain amount is less than 2 crores, then only can you buy two. If your capital gain amount is more than 2 crores, then one goes into one cannot go into two. So I just wanted to re-clarify that. On your question around FEMA, luckily for now we've had a change in the ODI guidelines, LRS and all, but no reverse issue guidelines where they've had any restrictions on NRIs, because we want foreign exchange to come in. So I don't think that's likely to happen as well. The only restriction, as I put right in the beginning, is that if you're buying any plantation or anything categorized as agricultural land, and if you look at the land registry, they will say agricultural land or boundaries, etc. There you need special permissions. You'll have to go to the RBI to take a permission to buy that agricultural land. Have we seen people do that a lot? No, not really. And so I can't really, if the next question is, have you seen it and do people get permissions? Not really. But we've also seen that a lot of people, NRIs who are buying, and that's where no FEMA restrictions come in, is that they're offloading one and buying a bigger one or something more luxurious, or a holiday home, and all the trends that Samir spoke about. So it's not really this embargo on buying agricultural land has not really worked as an impediment for now in the segment that we are looking at, because it's for obvious reasons. But that is the only restriction that is there at the moment.
And a very connected question to that is from one of our customers, Mr. Pradeep Agrawal. I'm a recent NRI. My parents own some properties which they want to sell and share the proceeds with me. How the money can be remitted to me, and what are the taxation around it?
So, Mr. Agrawal, let me answer your first question first. Since you are a non-resident of India, I'm assuming that you would have an NRO account, okay? And when your parents sell the property, they can give the money to you. There is no inheritance or gift tax in India at the moment. When they sell the property, they will pay capital gains, and I spoke about 2 years, less than 2 years, indexation benefit, etc. So they will do the capital gains. They will have to pay the capital gains, and then they can give you the rest of the amount. Net of the capital gains, and I'm assuming they don't want to use 54 and 54F to reinvest. Once the money comes into your NRO account, then you can actually freely repatriate $1 million a year plus current income. So there is no approval needed. What the bankers will ask you for is proof of tax paid, etc., which you can give. But otherwise, you can send out 1 million plus any interest, etc. And there's no cap on this current income as of now. So that's how you can send the money easily outside. And depending upon what the gain is, if it's much more and there's much more that's come into your account, you'll have to then, spread the limits and use the 1 million limit every year. So I hope that answers the question.
And Surabhi, for the parents, I think the LRS limit will apply, right?
Absolutely. So if the parents are residents, then they can remit up to $250,000 a year. Again, there's been a change in the LRS and ODI guidelines effective August 22nd. The parents can send the money outside, but they can't just park it into a bank account outside. The money has to be reinvested as per LRS rules. For example, in listed securities as portfolio investments, or they can buy a property overseas. Samir can help with that as well, and use the LRS limits. Another important thing, when you use your LRS limits to buy a property overseas, for example, if it's 4 people in a family, then the house has to be registered in 4 names. So the way the rules go, the LRS limit should be equal to the proportion of stake or ownership you have in the property. So that's really how the whole deal in terms of FEMA works.
So in this particular case, so the parents can gift to Mr. Pradeep Agarwal,
yes,
but to the limit of $250,000 per annum.
Correct.
Per parent. So
yes, correct.
The property is between both the parents, mother and
Absolutely.
father. Then together they can
gift
him 500,000.
Yes, because Pradeep has become a non-resident. So the parents, when they gift, they have to gift because it's a resident gifting to a non-resident. So therefore, they have to follow their $250,000 guideline, and therefore they both parents can gift him 250 plus 250, but he can send the 500 outside because his limit is $1 million. So that's the complexity of FEMA here.
So let me just ask for a clarification on that point. If I sold a property, and again, Mr. Agarwal was my son, and I sold a property in India, and I got 10 crores, which is the equivalent of $1 million, I could technically gift him the full 10 crores in India, or I couldn't gift him the full 10 crores. It would only be 250,000.
So Samir, the jury is divided on this one, very honestly, because the parents are residents and he is already a non-resident. So therefore, because it's between a resident and a non-resident, so therefore the jury, the technical reading of the act or the FEMA guidelines say that the 250,000 limit should apply. Had Pradeep been in India when the sale happened and not yet shifted, then they could have given him the entire 10 crores, because then FEMA wouldn't apply because it's a resident to a resident transaction. So that's the beauty of FEMA. So the planning Pradeep could have done is that before he left, the parents could have gifted him everything. He could have had it in his bank account, no gift tax in India. The bank account would then, after that, when he became an NRO, he could have taken the 1 million. So that's something to be very careful about. This is the way the rules read as at the moment. Like I said, the jury is divided. It's an interpretation. We're waiting for more FAQs to come, maybe from the RBI, and maybe this is addressed. But that's the way the bankers are looking at it at the moment as well, isn't it, Deepthi?
Yes, absolutely, Surabhi. That's the reading of the regulation.
Yeah.
So, Surabhi, the next 2 questions are also pertaining to tax, for the right reasons. So the first one is from Ms. Surabhi. It goes as, when can pre-EMI interest paid be offset against income for the property?
Okay, Surabhi, you have a lovely name. So the pre-EMI, there is no separate, no separate section in the income tax law relating to pre-EMI interest. Pre-EMI interest is allowed to be, as in terms of when it can be done, there is a separate law. Sorry, there is no separate limit in terms of 2 lakh rupees, but you can start taking a deduction for pre-EMI limit only once the possession of the property is done. So in that sense, any interest that you take as an offshoot on the mortgage, remember I spoke about rent, which is 30% minus the interest. Technically, the interest payment is only allowed as an offset once the property is completed. So therefore, pre-EMI interest also you can use then, but it will have to fall within the limit of the 2 lakh rupees that you can finally set off. So you will not get 2 lakh plus all the throngs of pre-EMI interest. So you start 2 things. The limit will remain 2 lakhs, then carry forward. And it will only start, the interest clock or the deduction is only allowed from when the property is completed. And there are, people say, is certificate of registration okay? Do you need to have possession? There again, the jury is divided, but it should be completed. It can't be done for an non-constructed or WIP property.
Surabhi, the next question is from Mr. Satish. It goes as, for interest deduction against rent, does the loan have to be a mortgage, or is loan against property also accepted?
It can be anything. The law doesn't talk about specifics of the loan. And, but if there is if there are any doubts around this, it's, useful for your chartered accountant to look at it, but they have not prescribed that it is a loan from a bank or a pure mortgage, or it cannot be a loan from an existing property. Many people take loans on an existing property to fund the new purchase as well. So typically there is, if you read the section, it's a two-liner. So it doesn't give any specific restrictions. So to my mind, it should be allowed. But because there are finer nuances around this, it always helps whoever's filing your tax return to just do a little bit of a reading. But there's nothing explicitly set out which says you can't take it.
Okay. So I know we are almost on the top of the hour, and unfortunately, we have to come to an end of today's session. Surabhi and Samir, thank you for your time and valuable insights. And to our customers who've joined us today, I hope this was useful. Please do keep tuned in for our future sessions. And in case you want us to take up any particular topic for your future session or share your feedback, please do feel free to reach out to your RM. Thank you once again, and good day.
Thank you.
Thank you, Deepthi. Thank you, everyone. Thank you.
Bye-bye.
Bye-bye.
And have a happy Diwali.
Happy Diwali to everyone.
Happy Diwali, everyone.